Hey everybody, welcome back to another episode of A Millennials Guide to Real Estate Investing. Today I have Brett Crosby, COO and co-founder of PeerStreet. Previously, he was a founder of Urchin Software, which was then bought by Google and turned into Google Analytics. So thanks for coming on the show today, Brett.
Yeah, super happy to be here. Thanks for having me.
No problem.
Really excited to chat.
Yeah. So awesome. Let's start with your backstory. So you went to USC, you graduated right out of college. Did you start Urchin, and then Urchin you worked on for a couple of years, which was then eventually bought by Google, correct?
Yeah, roughly. I mean, right out of college, I did a couple of other projects, and then in doing that, I started working with my brother, who was in doing building websites.
Got it.
And I kept sending him business, and eventually he's like, "Why don't you just come work with us?" And so I started working together with him and this guy who we grew up across the street from. And during the process of building websites, we were like, if we could really focus on software, we could build something really cool. Like instead of just building a website and then moving on to the next project, we could do some really interesting things. So we started building software on the side, and then we had this idea, and we did it mainly for our customers. We're like, we built Urchin as an internal tool to like tell people if their websites were getting traffic or not, So we built that, and then we ended up refocusing the whole business just around Urchin and recapitalizing the business, kind of refounding it really. And then I came up with these whole business models of how we're going to put banner ads on it, and it was going to be ad supported, and we could give it away for free, and all that, different than most web analytics products. And what's funny is we didn't end up keeping that business model, although it gave us the confidence to go do that and recapitalize. And then, by the way, we brought in a fourth co-founder, this guy, Jack Ancon, who was a buddy of mine from college, great dude. And then what's really interesting is we ran Urchin, and the company was doing really interesting stuff. We got acquired by Google, and then once we were at Google, we were able to actually do that business model and give it away for free, but we didn't ads on it. But it effectively is ad supported at Google because that's how Google makes all its money. So it's just funny to see it all go full circle.
That's awesome. And then talk about how. So you had that, you were really, tech heavy. What made you interested into real estate, or did a partner come and approach you? And, how did that lead into what you're doing now, which is PeerStreet?
Yeah. So I was at Google for about 10 years, just about to hit my 10-year anniversary, and done a bunch of different things at Google. And one of my very good friends from college actually reached out to me while I was at Google and said, "Hey, I've got this idea. I've had this idea for a long time, kind of like I've been kind of working on it, but the timing is perfect with the Jobs Act passing. The technologies has, kind of come a long way. And really kind of most importantly, you've got general market acceptance for investing in fractional loans as an investment class. This is like 2014. We had, guys like Lending Club had been around for a while. They were, I think, about to go public, or maybe had gone public at the time. I think about to go public. And just generally, like, people were really interested in these other investments. And we were looking at the returns, the yield people were expecting on those investments with an uncollateralized, which we can explain what it is, but product. And we're like, look, if you can do something very similar with real estate debt as an investment, but it's actually collateralized by real estate. And so for us, we thought that was a much more interesting play. What it turns out is it's just much harder to do consumer credit. We knew that going in, but I don't think we knew exactly how much harder it is. But we really did come up with a business model, even in those early days, that we believed could scale in ways that no one else had really been able to do in this space previously. And I think that's really we've really stayed true to that concept, and it's worked very well.
Yeah, and then explain to the listener what PeerStreet is and what PeerStreet does.
Yeah. So, and by the way, the guy who approached me with my college buddy, his name's Brew Johnson, and he's my co-founder, and he's our CEO at PeerStreet. PeerStreet's a platform for investing in real estate debt as an asset class. And basically what we do is real estate debt's been around for a long time. It's like this asset. It's one of the largest asset classes in the world, really, because the mortgage finance market and just the U.S. mortgage finance market is massive.
Yeah.
But it's one of these markets that most people had almost no access to. It's like really kind of owned by Wall Street for the most part. And so we thought is like, look, there's got to be a better way to do this than the current securitization market and all the stuff that led up to 2008. And if you rebuilt the system properly, you could actually allow individuals to invest in stuff, and they would be a lot smarter than the way things were packaged up and sort of hidden. Massive pools that led up to 2008. I'm sorry, that's maybe too much in the weeds, but that's a lot of the thinking that went into this, because my co-founder, Brew, is a real estate attorney, or he was a real estate attorney. He saw all this stuff go bad, or he knew it was going to go bad way before 2008. And so, but the concept of PeerStreet is, look, let's just let individuals invest in real estate debt in a way they never could before, and let's take all the hassle out of investing in this asset class, but pass on the benefits of it.
You got it.
So that's really the idea. And as I said, Wall Street's had access to it for a long time, and so one of our like kind of early mottos or taglines was level. We're trying to level the playing field between Wall Street and Main Street.
Got it. Okay, cool. And then so let's say I'm a user, I go to your website, and I have, what's the minimum investment that somebody can even make on your website?
Minimum investment's $1,000.
Okay. And then as a user, do I get to choose, which investment or which debt my property goes into, or is it kind of just I'm investing in you guys or through the platform, and I don't get to see where that money is going into, or what's on the other side of the screen that I'm seeing?
Yeah, there's a whole login experience. You need to be an accredited investor to make it through the login process. But once you're on the other side of that, what you described, the kind of opacity and not knowing what you're investing in, that there's so much of real estate debt investing is like that. You just don't know what you're getting.
Yeah.
And so that's a lot of the content behind it is now take that away and make it very clear exactly what you're investing in. So you can see the exact property the loan has been made against. These are all first position liens on real estate, and which means you're in the first position to get paid back. And you're not, most people understand about investing in real estate equity, like the property themselves, which I think you do personally and professionally. But most people don't understand about investing in real estate debt. And that's because historically it was really hard for individuals to do that, for people like you and me to do that. And so we've changed that with PeerStreet. And what's interesting is like that's where banks have always been basically, and like the lender is usually on the debt side, and they love it because they're protected by your equity to a certain extent, right? So the equity position is the first risk of loss, and then the first lien debt holder is the first to get paid back in any sort of, if you have to foreclose on the property or whatever. So what we do is we make it so you can invest in these pass-through securities that are represented as the loan. And so effectively what happens is you can pick and choose on the website. It's like investing in stocks, almost like an E-Trade. You can see photos of the property, you can see comps. We show you all this data about what you're investing in, and including borrower information, although we don't share the exact borrower name or exact FICO score, but we show ranges and things like that, so you get a sense of quality and experience and all that sort of thing. And you can see who the lender was who made the loan, and then you can choose to make an investment or not. And you can see it on Google Maps and all that stuff. Right? You can see the address of the property. And so we just make it very, very simple to kind of pick and choose your own deals. But we also have something called automated investing, because higher yielding deals tend to go fairly quickly, and we don't want it to be like a speed game, like who can click the fastest, which that's not a great that's not a great sort of thing you want to encourage when you do want people to take a moment to be able to know what they're actually investing in. You know what I mean?
Yeah, exactly.
And so we have this thing called automated investing, and it actually, when you set it up, you can set your parameters up, and when loans come on or investments come on that match parameters, there's like a queuing system. As long as your turn to be able to invest in a deal, it'll automatically put you in that deal. It holds you for your spot for 24 hours, and then it'll make the investment. You can back out within 24 hours. So that gives you the chance to really diligence it yourself and look through the information, decide if you want to do the deal.
Okay, cool. And then what's the range of returns? What's a high yielding return for you guys on PeerStreet today, and what's an average return that people are making?
Yeah, so the range you're going to see is between roughly 6 to 10%. annualized.
Got it.
And the term can range from like 6 months to 36 months. So that's how long you're kind of like in the deal. And then our max loan to value, so LTV, which is sort of a good proxy for, it's sort of it's kind of top level proxy for risk level. There are definitely other risk factors. I'm not trying to imply that's the only thing, but that's like the top level thing is like how much you're lending against the value of the property.
Yep.
And so we show that information very clearly. So that our max currently is 80% on certain deals, but historically it's been 75%. Okay. Max loan to value, and our platform wide is roughly, I believe, 66%, somewhere around there. So you just take all of the deals that have ever come through.
Yeah,
it's still, give a reasonable cushion there.
Got it. And then for the deals so I'm assuming you have investors who are coming to you guys and looking to have PeerStreet be first position debt on their investments, right? Do you guys have underwriters who are underwriting those deals? Do you guys just have a select few investors who, do continuous deals every a couple deals a year that you're just pushing those investors on your website? Or what kind of due diligence, if any, do you guys do on the investors and the deals that are being presented?
Yeah, so on the supply side of bringing loans onto the platform, we do a tremendous amount of diligence. So there's a lot that goes into it. I'll just give you a sense, like just to be clear, because it can be confusing. So for your listeners, I want to just clarify. We have investors like you and me on one side of the platform, right? And we come with capital to invest. And the other, and then we also have like large institutions investing, et cetera. But what makes it really unique is that individuals can invest in a way just really never before possible. And they can easily invest without broadly diversify across like lender, geography, loan, all that stuff very, very easily. And like we handle the sourcing, the vetting, sourcing loans, vetting of the lenders, vetting of the loans, et cetera, before they come on the platform. It doesn't mean it's like absolutely perfect and there will never be any flaws with there can never be any issues, but we do a tremendous amount of upfront stuff. And so I'll just give you a sense for what that looks like. So the way we source loans on the other side of the platform, we're not typically a direct lender. And the reason we decided not to be a direct lender, there are a lot of reasons, but primarily because we wanted to be able to scale this business while maintaining a high quality supply of loans. And so instead of going and competing with the thousands of lenders that make these types of loans throughout the country, what we decided to do is actually create almost like a kind of a Fannie Mae and securitization market for them, like a secondary market, because like if you get a loan from your bank today, they usually will just they'll originate the loan, take some fees, and sell it off into the secondary market. It goes into securitization, all that stuff. That doesn't exist for the local private lenders that are doing short-term real estate debt loans, like bridge loans to buy a property, fix it up, and sell it, or to put a tenant in, which is the kind of loans we're talking about. And so we've basically created that secondary market for these lenders. But for them to be able to sell into that market, we vet them as a lender, look at their legal docs, do a whole bunch of deep dive on them as a lender, look at their background, track record, et cetera. Yeah. And then every single loan that they submit to the platform, we thoroughly double check. So they've already decided which borrowers they're going to work with and make a loan. There's no guarantee that we're going to buy the loan. In fact, about roughly half of what's submitted to our platform right now, even from the lenders we've already approved, which we have hundreds of lenders that we work with in over 40 states now that are submitting loans to the platform. We pick and choose. So only about half of the loans that are actually submitted make it through our approval process. And our approval process is this whole underwriting process where we have a manual process. We pull a bunch of data to look at the submarket. So first the lender weeds out bad borrowers, ideally, right? And then they decide to make the loan or not. That's the first kind of line of defense. And the second one is then we are looking at it with data to say if the data looks like it makes sense. And the data looks like, what's the market look like today in that submarket, historical look, importantly, what's the forecast? And we use hundreds of data points to kind of figure that out. And then we do a manual double check of everything, make sure all the legal docs are right and all the deed's been recorded, all the stuff that you need. And then we actually purchased the loan on behalf of our investors. And then because real estate, it takes like, you have to re-record the deed and there's all these details.
Yeah.
We hold it for like a week and then we put it out, roughly a week, and then we put it out for investors on the other side of the platform.
Got it. Awesome. And then what kind of deals are we talking about? So are these more single family home flips that you guys are, because you said bridge loans, so you mentioned that. So
Yeah.
are you doing that? Are you guys doing retail and multifamily, or what kind of deals are on the platform?
Yeah, everything you mentioned, actually. So we started just with SFR, single family residential, and these are all bridge loans because people like you and I don't want to be locked up in a 30-year mortgage, right?
Yeah.
There's a path for us to potentially get there if we create liquidity where you can trade in and out of those, but today that doesn't exist. So yeah, these are all short-term bridge loans on single family residential properties. We recently rolled out multifamily like this past summer.
Awesome.
Small balance commercial. There's like, some retail stuff with that, et cetera. So, and then we'll be adding additional real estate, loan asset classes as we continue to grow.
That's awesome. And then even for the multifamily, is it all short-term bridge loans, or are you guys doing any long-term stuff right now?
Yeah, that's a really good question. And what's fascinating is the lenders we work with, the capital that they've had access to has only been for short-term deals because they raise from like the country club. And those people don't want their money around, like people like you and I don't. If we're investing in a lender's fund, want our money locked up for 30 years either in that fund.
Yeah.
So they didn't have access to longer-term capital. But as we've grown this platform and created a true marketplace, right, two-sided marketplace, now we have large institutions investing alongside individuals as well. And those large institutions are actually happy to put their money to work for a much longer term. And so we're now just starting to unlock in some pilot programs the ability for our lenders to do longer term buy to rent loans. So they can do the bridge loan, which is like a year and a half type of thing. And then once someone's like fixed up that property and got a tenant in there, they can do a longer term bridge loan. And what's fascinating about that is now these lenders they've already underwritten the borrower, the property, the borrower's firm. Now they have a tenant in there. It's like should be able to do that longer term loan, but they couldn't historically. But because of our platform, they can start to make those loans, which is good for the lenders, but it's also good for people like you and I who are like investing in real estate. Like, if you and I are like buying real estate projects and we need longer term financing on that, but have a tenant in there. So we can provide more options for borrowers as well via our network of.
Yeah, because the thing is, a bridge loan only lasts for so long, and that person needs to do a refinance and get money for the long-term debt. So if you guys can provide every single piece of it, it makes it a whole lot easier. Because I bought a 20-unit apartment building, and we're using a asset-based lender for that. We're paying 6.5%, but I'm gonna increase the rents, increase the property value, and then do a cash-out refi with a Fannie or Freddie Mac, and with a much lower interest, 2 points lower in interest, but it was essentially a bridge loan, so I can just get the deal done and get the deal going. Right.
Exactly, and that's why these bridge lenders exist. So that for exactly that is, as you know, but just for your listeners to know, bridge lenders basically exist so that people can buy a property and kind of get it to a place where it is going to conform and they can get longer term financing. It's that's why they call it a bridge. It gets you from kind of that starting point to where you can where you need to be able to get the longer term financing. But yeah, that's the idea with PeerStreet is longer term we can start unlocking more and more loan types for lenders, more opportunities for borrowers, brings lending back to the local communities. It does all these really positive things. And in the meantime, it makes a great well, I can't opine on if it's great or not. It makes a new investment class. And it makes an asset class available to investors in a way that just was not available before, right? So, that's the idea.
Absolutely. I was going to ask you one. Do you guys ever think that you will open up the space to non-accredited investors in the future?
We would. So that is definitely in our DNA and something we would like to do. That's like really part of what we're about when I talked about leveling the playing field for everyone. We would like to make it so like literally anyone can invest in real estate debt as an asset class. And it's so yes is the short answer. It just is going to be a little bit of time to get there. And it's just crazy to me that people can invest in, Bitcoin and things like that, where there is no actual asset. But here you've got real estate debt, and there is an actual asset, and you have a little bit of, you don't have that equity style exposure. you're like way less exposed than an equity investment in real estate or equity in the equities markets and buying stocks or Bitcoin or any of that stuff, where you could literally lose all of your money if the stock goes to zero. Here, is that sort of risk is muted by the fact that there's an actual property, collateral. The deal.
Absolutely. Yeah, and all the lenders are on. Oh, so that brings up an interesting question. So, you guys are in first position, right? Or the loan is in first position that people are investing in on the debt of these properties. Does that mean all these? How does that work in terms of the legalities of being in first position when you do have this large pool of investors? Because I always thought because the only person on title is just going to be one company or one LLC, correct? But then behind that, there's all these people.
So the way it works with PeerStreet is that, which is very similar to how Lending Club works if you're familiar with that. But if not, that's fine. I'll just explain it real fast. So PeerStreet actually buys the loan, and we hold it in a bankruptcy remote special purpose entity, meaning that it's like you're not taking risk on PeerStreet going out of business if you're invested in that loan.
Okay.
If you were to go out of business, someone else can that and they get the payments out and all that stuff. So we pay a fee ongoing to make sure that in the absence of us, that still happens. And we hold the actual loan there, then it's a pass-through security that you're actually investing in is the legality kind of thing of it. Okay. But I'm not the lawyer, but a layman version of this. And basically the way it works is it's a pass-through security. So we call it a mortgage dependent payment note. And so as long as someone's paying their monthly interest payment, that then gets passed through to the investors in that loan.
Okay, got it. Yeah, so all the investors who are investing in that thing are technically in first position through all these pass-throughs.
Yeah, exactly. And we as the owner maintain that first position on the loan, and then that gets passed through to the individual investors.
Gotcha. Okay, cool. Last question. What do you think about current real estate market? What do you think about what's happening with the interest rates or where the market is going? Are you guys slowing down on your lending because of it at all, or are you doubling down or saving cash, or what are you guys thinking in terms of the market?
Well, I mean, look, I can tell you that I've tried to time real estate markets in the past. Sometimes it doesn't. I mean, I'm in the process of actually building a home personally right now, and but that said, I just sold a threeplex 2 days ago. But it's less about trying to time the market, more of just what's going on with me. But for the business, we've built this business with the concept that we know real estate is cyclical. Yep. So we've always tried to make sure that, regardless of where we are in the cycle, that we're doing things that we believe are in the best interest of our investors and just generally kind of the right thing to do. We've taken a more conservative swath of loans. We could have grown faster, although, just to give you a context, we've been live to the public for 3 years and we've done $1.5 billion in volume. This year alone, we did $1 billion in volume. And, we're north of, well into the 100+ range monthly at this point, million a month in, investments and loans going through the platform. And we don't see that anytime dying off. And really what we think is that, here are the two kind of key points I think are really important here. Markets have been fairly choppy over the last few weeks, right?
Yep.
A couple months, whatever it's been. If we go into 2019 and the markets are still choppy, what's really interesting about this market versus call it just 2008 as an example, or kind of previous cycles, is the smart money on Wall Street has been able to go invest in real estate debt to get a little bit to stay long in the market, but to get a little bit of, not such an exposed position. But individuals did not have that ability before because there was no direct way for people to invest in real estate debt. They could go in REITs or other things where it's all just like you described, very opaque box. You don't know what's in there. It's hard to actually manage what you're doing. But with the thing that's really unique is that now individuals can do the same thing that institutions can do, right? And they can seek a little more,
security or
little interesting harbors, you know what I mean, to
Yeah,
kind
yeah,
of weather the storms. And but say you're wrong and the markets go gangbusters for the next like 10 years or something, you're still getting like,
yeah,
a reasonable and interesting. There's interesting yields still to be had here. It's not like you're sitting in something where you're making like a bank account
yeah,
or something like that. So and then the second point is that we've really built this business to be a good business in up markets, but a potentially great business in a downturn. And the reason for that is that there are a lot of buyers of loans in an up market at the tops of markets, but a
yep,
lot of them dry up at the bottoms of markets. And so if you just look at 2008 again as an example, um, a lot of investments were still being done. It was hard for capital to find projects, but
yeah,
real estate entrepreneurs like yourself were out there making projects happen, et cetera.
yeah.
It was hard to get financing. But when they met, you could get these really interesting deals. And so with a marketplace model that we have with PeerStreet, we believe we will still have investors of all various stripes, individuals,
Yeah.
institutions of like we have 9 large institutions buying on PeerStreet right now, and these are like oftentimes like $100 million forward flow agreements type of things, like very
Wow.
large agreements, like
Yeah.
$100 million annual kind of deals that that they're targeting. And so say some of the hedge funds go away. Well, that's okay. We have credit funds and foundations and other types of investors
Yep.
there. So there should still be liquidity regardless of the market and deals to be done. And so you can see how like if the market does drop, like it should sweeten for investors and the deals should actually get more interesting.
Yeah.
So that's kind of any healthy market. There should be supply and demand available and
On
like
both sides.
adjust with supply and demand and like et cetera and scarcity. And so that's really what we've built with PeerStreet, and it's something that I was talking to the head of innovation at Fannie Mae the other day, and the topic came up about Fannie Mae and like what happened in 2008. And basically what was discussed is in 2008, going in, 2007, basically the GSEs, Fannie Mae, Freddie Mac, et cetera, had about 40% market share because there were other loan buyers out there. After 2008 and the crash, they had 95% market share.
Oh my God.
Town buying, and there are a lot of reasons for that. They're government backed. There's like
Yeah.
but they became the default marketplace during that time. And when they came out of 2000, when the economy started to recover, the interesting thing is they actually maintained their 95% market share. So what we believe is there are a lot of other ways to invest, like other loan buyers out there. Usually these loan buyers are buying for an individual institution and just kind of feeding it to an institution, and they're not allowing people like you and me to get into those deals. So they're very different than PeerStreet, but we believe a lot of those one-off buyers kind of go away.
Yeah.
They're buying for a single source if there is a major downturn, and then PeerStreet becomes the default place to actually transact. And then after that, that default status could potentially maintain throughout the future. And so that's where the network effects of a two-sided marketplace like this really start to unlock and become very, very powerful. Not just for PeerStreet, yes, for PeerStreet too, but really for everyone involved, like all the participants.
Yeah, absolutely. Yeah, and even during a downturn, you could see lending increase because a lot of the lenders may even dissipate, whereas the returns for the individual investor who is a smart investor was smart with their money, the returns may go from 6% all the way up to 12% during a down market. Maybe the best time to invest. Yeah.
And you saw that in the last downturn where where you found deals like these deals, some of these real estate deals were really, really interesting deals from an investor perspective.
Yeah, absolutely. Awesome. Well, thanks for coming on the show. If people want to get in touch with you, maybe ask you some more questions, is there a good way to get in touch with you?
Sure. They can always shoot me an email at bc@peerstreet.com.
Cool.
I'm at Brett C on Twitter, and I'm Brett Crosby on LinkedIn. So those are all very easy ways to get in touch.
Awesome.
I end up posting a decent amount on both LinkedIn and Twitter, so you can get a sense for, I've really taken a lot of the Google culture and also Google Analytics kind of data approach, and also just kind of Google ecosystem approach to building this business. Bruin and our third co-founder Alex, we've really applied a lot of those concepts from the tech industry and Google in particular to building this business and also our approach for how we're building something really unique where the whole ecosystem actually benefits from our presence rather than like a more traditional finance Wall Street approach of just trying to extract as much value as you can. You know what I mean?
Yeah.
And so the reason I mention that is if you do, you can reach out on those channels or even just kind of take a look at what I'm posting there. And it's always, there's a lot of fun stuff that, kind of give you a sense of the culture inside the company, et cetera. And you're here in LA, we're in El Segundo, right off, basically right on the border of Manhattan Beach.
Awesome.
And, in the last 4 years, we've grown to 170 people and we're continuing to grow. So, and we're always looking for smart, talented people to join the team. So just a little plug on the hiring side.
Yeah.
I also think it's important, like if people are passionate about this stuff and interested, like that's a perfect person to check us out,
Oh yeah, absolutely. Yeah. What a great a company of that size who's doing something unique in the industry, who's breaking the norm. It's definitely a company that, if somebody's interested in working in real estate and learning the behind the scenes on both sides of the spectrum, what a great place to be. And especially with the Google culture that you guys have built around the company too. Yeah. Great opportunity. Well, thanks for coming on the show. Thanks for coming on the show and sharing with all the viewers, and hope to have you back maybe next year.
Absolutely. Thanks so much for having me.
Thank you.
Okay.